And so that very big gulf there makes it to where the switching costs in the housing market are very high. Somebody with a lower monthly payment and a lower rate, if they're going to go sell that and buy something else, that's going to be a huge affordability shock to them. You could have a circumstance right now in the US where you sold your home and you go and downsize and buy a smaller home and you would get a bigger monthly payment.
If you're not getting educated about local and national real estate market conditions, news, and all the industry trends that are out there, you're doing yourself and your client base a disservice. This is the Knowledge Brokers Podcast. I'm Tom Toole here with Byron Lazine, but who cares about us? We've got Lance Lambert on from ResiClub, three-time guest. This is the hat trick here. Very excited to have you on, Lance. Thanks for making some time.
Yeah, appreciate it. Housing. There's always so much going on.
And if you're not checking out Lance's website, it's ResiClub Analytics.com. This, to me, is the go-to spot to understand trends nationally. And the coolest thing about the site, Lance, what I really appreciate is the local snapshots that you do. So you get the national trend, but it also shows where it's going locally, because not every MLS showcases that information. Great follow for any real estate agent that's out there, or if you're in finance, accounting, mortgages, obviously. A lot of good stuff to follow, and it's going to position yourself as the knowledge broker. So ResiClubAnalytics.com is pretty easy to get signed up, right, Lance? Not a big deal. It's a couple clicks.
Yeah, just put in their email. They'll be on the free list. Exactly.
Love it. Very cool. Well, the best website to follow, in my view, in real estate. I'm a paying member. That's how good it is. So that's a big shout out there. Lance, thanks for coming on. I wanted to hit on a very somber note first, the LA wildfires. And what we're seeing happen, and Byron and I, we've had very close friends of ours, a lot of real estate agents obviously have been affected. There's been some really cool things happening with people like Ben Balak from the agency, really rallying the real estate community there. But we've also heard that insurance has been a big problem. Our friend Eric Crumbaker, who was in Pacific Palisades, actually lived there. He's reporting that insurance companies aren't even getting back to people. And it's been obviously some time has passed now. I'm curious what you're hearing on the insurance front, and maybe what some of the what people should expect, and any intel you have on this to start.
Yeah, well, I think the interesting thing with the insurance and the big story there is to kind of zoom out and see the big picture, right? And not just necessarily what's occurred in some of these pockets of Florida or in some of these pockets of California, but the home insurance market is getting hit by a shock. And that shock, a big part of it is driven by the fact that home prices and construction costs went up so much during the pandemic, right? And that has a lag to get into things like property taxes. Everybody's municipalities and different states do it different ways. And in many of those, there's a big lag in terms of it coming into the market. And then with insurance, there's a lag there as well. And so the past couple of years, we finally have been seeing more of that catch up, right? That echo pandemic housing boom with the insurance market. Now, some of these states have insurance markets set up different ways, and some of them, have politically appointed or politically elected, people that are in the insurance commission, right? And
Okay.
they can kind of prevent some of these insurance hikes, right? Or slow them down. And when you do that, and, some of these insurance companies don't have, can't sell at a profit insurance, right? Into some of these markets or some of these states, they leave, right? And so that's a part of it. Another factor there is, according to CoreLogic's chief innovation officer, well, he's now actually CoreLogic's chief data and analytics officer, John Rogers, and he's a great follow on LinkedIn. He says there's 6 factors that go into driving this home insurance shock. And one is that I went through with you is the construction cost, right? The replacement costs have soared 44% since the pandemic start. Another factor is natural disaster frequency, and that has increased over the past few decades. Another factor is risk concentration. The number of housing units in these riskier areas has increased, right? In these pockets of Florida, right? In these pockets of California. And so when you do have these disasters, because the homes in those areas are worth more and they're more concentrated, it increases the losses, right? That's another factor. The state regulations, some of these well-intended regulations have caused market retreat in high-risk areas. State lender of last resort concentration. Public homeowners insurance reached a new record in 2023 of over 1.3 trillion. And then reinsurance cost. The spike in reinsurance premiums further compounds all of this. And so, the number of homes in very high climate risk right now is 9%. And over the next several decades, CoreLogic thinks it's going to go up to 16%. So we're going to continue to build more and more into the most risky areas. And so can I share my screen to show you some charts?
Yeah, I would love that.
For insurance.
Awesome.
And some of these haven't published yet. Still kind of working on them.
And then Lance, you can also send those charts into us. Bobby will get them into the post edit, but definitely share it with Tom and I so we can see it. Perfect.
Awesome.
Oh, wow.
So this is the non-renewal rate for home insurance. Wow. We haven't published this yet. This is just something we've been working on the back end. And so you can see in California, in Florida, so coastal Carolina, actually even pockets of like Oklahoma right now. Well, that's probably tornadoes and wind damage. Very high numbers of non-renewals from these insurance companies pulling back. This is the median annual home insurance premiums, and Florida, very high, leads the country in some of these pockets of Louisiana. What's kind of surprising is that California really isn't that high, especially when you start to factor in home prices there.
Mm-hmm. Knowledge Brokers, thanks for joining the pod today. We're going to get you right back to this episode. If you want to help support BAM and join the thousands of agents transforming their business, join the BAMX community. Use Knowledge Brokers, the link down below. Got a little special deal for you. Use Knowledge Brokers, link down below. Now back to the pod.
Now, here's the main one. And this is the 3-year change in median annual home insurance premiums. And you can see the shock here has really been concentrated in the Louisiana market, the biggest. Some of these Mountain West as well, and Florida. Now, the reason that matters for Florida and Louisiana is if you saw some of the other ones that I showed earlier, they already pay the most for insurance, right? And so Florida pays the most for home insurance, and they're up the most on a percentage basis. And that's really, that hit of that affordability shock there for Florida.
And Louisiana's, over the last year or 2 years, probably been the most impacted when you look at, prices moving down, right?
You're jumping ahead on me, and that's exactly the next point I was going to make. So this scatter plot here is 3-year change in home prices. You read my mind, and 3-year change in home insurance. So you can see with Louisiana, they're getting hit hard by the insurance shock, but prices haven't moved up as much as some of these other places, and they've actually fallen a bit in Louisiana. Florida's fascinating. Florida is all these blue dots, and this is the 500 largest U.S. counties. And you will see that Florida, the counties in Florida, like Lee County and Sarasota County, Palm County, Hillsborough, Martin County, these are the places in the country where home prices are up the most and home insurance is up the most. And there is a correlation there where the home prices are helping to drive, and the construction cost helping to drive up the increases in insurance as those replacement costs move up. But what you will see is that Florida is just getting hammered by a very unique affordability shock that's stronger than a lot of the other parts of the country. And so I think that affordability shock and some of the slowdown in the pandemic migration explains why, plus, the shocks in the condo market for Florida explains what's going on in that market in the current softening.
Fascinating. And so looking at this, and when we're looking at what's going on in California, those those areas are really expensive. I think Palisades, I think I saw one of your ex posts. Palisades is about 3.4 million average price, somewhere in there. This is, when you look at some of these counties in Florida, that's definitely not the average price point. What's the future look like there?
For Florida's housing market?
No, if you kind of look at what's happened here in Florida and kind of look forward over the next couple of years in California, particularly the LA County area.
Yeah, well, so my personal view is I think that insurance rates are going to have to move higher in California.
Mm-hmm.
I don't think the risk is being covered. And, I think a big telltale sign of that is the coverage lapses, right? These insurance companies pulling out of the state, these non-renewals. And then the fact that when you look at, what Californian homeowners are paying for home insurance, it's really not that high. They've gotten hit, some of them by some bigger percentage increases lately. But, when you compare it to like Florida, in those earlier maps I showed, it's not that high. Now, one thing about California that is notable is that, especially coastal California, the land is worth a lot more than the home. And in Palisade places, I think it's, it could be, I think I read it's like 2/3 of it is the land value.
Wow.
So you'd be at 2.1, 2.2 million out of that average. The average price before the fires was 3.4, the average value.
Yeah.
That doesn't mean that that'll be the case moving forward, but if the land still holds its value, you're talking over 2 million.
Exactly. And so I brought that up for insurance, right? Whereas like the replacement costs are based on the home, the structure, not the land.
Lance, well, I saw the governor, Gavin Newsom, say, we're going to we're stopping insurance companies from being able to cancel. When I saw that, I'm like, that is probably going to get litigated by these insurance companies. They're, not allowed to cancel or obviously we just saw that a couple months ago where they canceled, or didn't re-up a lot of policies. How do you think that's going to shake out?
Yeah, I'm not exactly sure how that'll all play out. But, I do think if you shake down the insurance companies too much, you can't be too surprised when they leave the state. And that's kind of where when you looked at some of these charts I showed earlier, where kind of California, some of the concern is there is, so many of these non-renewals and so many of the insurers pulling out. The thing about regulations and the thing about policy is it can have a lot of unintended consequences, right? Like people try to do things and set policy and regulations with good intentions, but economics is complex, right? And incentive drives action. So it'll be interesting to see how it plays out. And back to what I was talking about earlier with land, you can see that the higher valued homes and properties in the country, they tend to have land make up a higher share of the value. So like San Jose, San Francisco, Los Angeles, San Diego are the highest, right? Where land makes up 60, 70, 80% of the value. And then a lot of the places like Louisville, Buffalo, Indianapolis, Memphis, lower.
Yeah, fascinating. When you talk about regulations, I actually have we have a short, maybe 20, 30-second clip Bobby can play here from an architect in California and I think Malibu architect, and we'll get into some of this regulation conversation here.
Phone all weekend with my colleagues, architects and builders, and we're all talking about just the same thing. It's all going to start with architects and engineers, but what we're really concerned about, we all feel that we're up to the task, but what we're really concerned about are our municipalities, and that's where we're really going to need to switch gears somehow. We all agree that we could get our communities back together in 2, maybe 3 years, if we're allowed to. In the old days when I started out, we were getting for houses.
There you go. If we're allowed to, do you believe if you free up regulation that LA could be rebuilt in 2 years?
Well, so I do think that there could be some innovation that comes out of this, right? There could be some regulatory innovation, right? In terms of like speeding some things up. California is notorious for being one of the places that puts the most hurdles in front of builders, right? Not only from the zoning side, but also in terms of the fees and the approval process is really slow, especially with the environmental reviews. So there could be some silver linings because those municipalities are going to be under max pressure, right? There's nobody who is, an angrier constituent than somebody who probably lost their house, right? Doesn't have a place to
Yeah.
live. And so I think they're going to be under a lot of pressure to act and act quickly. And they'll have to probably change their ways in some regards. I do think there will also, where regulatory hurdles could come is probably less so on the approval side because they're going to be under max pressure. It might be under, hey, we just had all of these homes burned down, right? And we are built in areas where there are historically, before all of us were even alive, there have been fires, right? This is just a natural part of those pockets of California. So, and then if you look, some of the homes that made it through this, they had homes right next to them burned down, but they had a different roofing, they had a different architecture. Like they were built with this in mind and not like, 1960s, 1950s homes. And so where some of the regulations and stuff like that could slow it down is trying to get more of these homes to be built up to a different code, right? One that's kind of thoughtful of, the fire risk, which could also help with the insurance side as well.
Yeah, that architect, he went on to say, you can wait right now 2-3 years just for the permitting, not even building. So that's going to really slow things down. There's another, regulation that there's a lot of support on this one for agents, people in the community that are in the middle of the crisis, and that is price gouging. Bobby, if you could pull up I sent you that email, rental marketing crisis, that second link on the second category there. If you could pull up, there's a couple of tweets, X posts. One's from the governor, Gavin Newsom, said just issued an executive order that will allow victims of the SoCal fires to not get caught up in bureaucratic red tape and quickly rebuild their homes. We're also extending key price gouging protections to help make rebuilding more affordable. Now, that's been commented on a lot. If you go to that second post, and if you want to zoom in on David Freeberg's post, who's California resident, he's part of that All In podcast, says capping prices to protect consumers will do extraordinary harm and limited good. It goes on to say, let's markets be free. The post is pretty long. Says the demand for home building will skyrocket in LA, causing service providers to rush in from out of town and out of state as demand and prices climb. These providers will ultimately compete prices down as supply swells. So he has a different view on, controlling prices in an emergency environment. I've seen a lot of agents take the other side of that. Where do you sit on this debate?
Yeah. So, I think in terms of like, the rental market, right? There probably will be just naturally some different limits to, how big those spikes can be, right? Like homes.com, I believe I read that they took some action on listings that ran up their price really high, really quickly. And, how much of an impact will that have? We'll have to see. But I think the bigger point here is in terms of, the rebuilding, right? And, these different contractors and that side of it, you probably have to kind of be careful about how much you do there in terms of trying to limit those running up, because they will run up. But like what you just showed before, that run up in price is what incentivizes investment of other people to come in to the market, right? Because you're probably going to have contractors move into that market for multiple years. And they're going to want to know, and feel comfortable, hey, I'm going to make a killing doing this. Now, is it bad that somebody is going to make money? Well, on the other side of it is it could speed up the construction and get more of these homes in faster. And the other thing is, in terms of limiting prices, it has unintended consequences, and it always has. Now, I think there could be some short-term places where it, might work for, very briefly. But I think we should just be cognizant in a market where, there's constant inflation, and, it's a market-based economy that, you could run into some trouble if you try to limit stuff too much, like we saw in the insurance market, right? Like we saw with, trying to keep rates down from this shock. That's really, a lot of it's an echo shock of the overheating for prices. And it had the unintended consequences of driving more insurers out of some of these states.
Yeah,
that's a great point that you talk about. I mean, I recently had an apartment building burn down in Louisville, Kentucky, and the lack of contractors has caused the rebuild cost to be more than places like suburban New York and Westchester County. So I think what you're talking about it's real life. I mean, I'm going through this right now. So I think that's a great point there, Lance.
And how long ago did that burn? What did that burn down for on you? A year ago, 2 years ago?
Not like 3 months. 4 months. It was in the spring.
I thought
it was this year, but
okay.
It doesn't really matter. I mean, it just and that's obviously a much smaller market. But my partner, he lives in Westchester County, and he's like, "Wow, I renovated this place for less than what." It really shows the challenges that are there.
Don't buy in Louisville, folks. Don't make the Tom Toole mistake.
I think we'll be okay long term, because luckily the insurance company's calling us back. But that's not the point. I think it's the labor issue is real. Anything we want to cover more about the wildfires here, Byron?
No, Lance, you did a great job there. It's a really obviously tough thing to talk about, and I think some of these issues that are going to be around for years to come, you did a good job covering what we know now. So appreciate that insight.
Yeah, thank you. And yeah, with the wildfires, there's only so much that I could add to that story, right? I'm kind of letting some of these other publications run in and do more of that on the ground reporting. Mine's kind of more focused on, the macro picture for home insurance, right? And the shock that we've kind of been absorbing for a while.
Yeah, that was a great breakdown. Let's move into some of the other stuff we want to talk about.
Yeah, so Lance, you posted this chart, and I know Byron, myself, and Lisa all have used this in trainings with our organizations and our teams about the interest rate on outstanding mortgages, and it was published Q3 of 2024, where it showed that 17.2% of U.S. mortgages are above 6%, and 73.3% are under 5%. Now that number has grown a good bit. I think a couple of years ago it was a lot smaller, which I see some trends there. But you're the expert, so you're talking to agents, you're talking to people listening to the podcast here. The trends you see there, how should they be using that in their business? What trends are you identifying? How can that help real estate agents find people that maybe are a little more motivated to transact, because that I've got a 3% rate objection still exists?
Yeah. Can you see that chart? I just pulled it up, shared my screen.
It's coming up now. Yeah, there it is.
Okay, awesome. And so what we have had occur is that we had a decade after, the bust of very low mortgage rates, right? And so the pool of mortgages that were outstanding, the effective mortgage rate on those kept declining, right? As more people refinance to lower rates. Then the pandemic occurs. We see that drop even more as we start to get those 3%, 2% mortgage rates out there. And some people for 15-year mortgages were getting like 2.2. And
Incredible.
So we saw the effective mortgage rate go way down to historic lows as we hit a 100-year low for mortgage rates. And then what ensued is an insurance shock where pretty much the monetary policy and rates normalized back to the historical average. And while it's the historical average, it was a big hit from where we were, right? And so what it created was a historic divide between the market rate, which right now is around 7%, and the effective rate, which is now closer to 4, but was when all this hiking started 3.6. And so that very big gulf there makes it to where the switching costs in the housing market are very high. Somebody with a lower monthly payment and a lower rate, if they're going to go sell that and buy something else, that's going to be a huge affordability shock to them. You could have a circumstance right now in the US where you sold your home and you go and downsize and buy a smaller home, and you would get a bigger monthly payment because the rates are so much higher now than they were before. And so what that's done to the market is it's really just taken off a chunk of the turn and the what I call churn, but resale turnover. And why I call it churn is they're going from one house to another house, right? It's not just the turnover of somebody died and that home goes into the market. It's that churn. So the churn part is been pulled way back. And so that's why we're in a market where we have, 4.2, 4.1 seasonally adjusted existing home sales versus in annualized. So whenever you hear the number like 4 million existing home sales, what that really means is that month, if given how many sales occurred for existing homes in that month, if you factor in seasonality and you continue that rate for 12 months, that's how many homes would sell in the next 12 months. So if you hear we're at a 4.1 million pace or 4.1 million, that's the pace we're on for the next 12 months. And before the pandemic occurred, we were really around, let's say 5.3 million existing home sales. So that 1.3 million that's cut off, it's really because of this chart here, where just the switching costs are so high in this housing market right now. And what we are seeing is we are starting to see more people get 6% above, 7% above, go above 5 here in this environment with, rates being much higher. And so we've been, I think this is 8, 9, 10 quarters straight where the pool of outstanding mortgages is drifting to a higher rate. And so now 73% of US mortgage borrowers still have a rate under 5, but last quarter that was 76. A few quarters before that it was 80. So it is starting to there is starting to be more people with these higher rates. And so the biggest impact that has is for the mortgage side of the housing market, right? Because when you go through these periods when the mortgage rate drops down, and it doesn't necessarily mean that it drops down and stays down, but like we saw late summer, the average 30-year fixed mortgage rate, according to Mortgage News Daily, dropped down to 6.11, right? And so that was like a 16-month low. And what we saw is a little bit of a refi boomlet where, it wasn't like a traditional refi boom, but within just a few weeks, refis almost tripled in a very short period of time. And then that since came way back down as, mortgage rates went back up. And really what that was it was the vintages of late 22, vintages of 2023, early 24, who got 7, 7.5, and even some people 8, 8.5 30-year fixed mortgage rates. And so they were taking an opportunity to refi. And so with the lock-in effect, I think the big thing there is I think we can slowly start to work out of it, but it's going to take time. And the biggest thing that would help is if rates dropped, but we haven't seen much of that lately. And so if we don't have rates drop, the other lever that you really have to lean and wait for is incomes to rise. Because as incomes rise and people make more money individually and as a household, they could get to a set of circumstances where, they have a 2-bedroom house, they have three, maybe they have they used to have just one kid. Now they have two kids. The wife's wanting more space. And so the psychological side of switching cost, starts to, affect the homeowners, right? They're not happy. And so that starts to pull down some of the financial cost in their mind relative to those psychological costs. And then if they could make more money, they would be more willing to take that financial hit of the bigger payment. So
Are there any points in history? Because I've seen your ex post on this in the past where the amount, if you just relied on income, it's like incomes need to rise, 50, 60% to make up that affordability gap. Correct me if I'm wrong on that number, but it's a substantial increase on income. Is there anywhere in history that we can point to where we're like, wow, incomes rose incredibly fast, in a short period of time, that we can point to and say, hey, maybe there's a new administration coming in, maybe there's going to be an economic boom, maybe that is in our future if we were going glass half full looking forward over the next couple of years?
Yeah. So one of the problems with the income part of it is you kind of get the catch-22 where it's like, okay, we could go through a burst where incomes rise faster, right? And we saw that a bit during the pandemic, right? As the labor market overheated, the inflationary wave kind of worked through the economy. But if you do that, you're probably in the environment where the rates are higher and they don't come down as much. And so you're a little bit squeezed there. And so it probably just takes a duration of time for those incomes to rise. Hopefully, home prices stay somewhat contained. And then maybe you could get a little bit of a relief from some of the rates, especially if like the spread normalizes a little bit. And some of the volatility that's still in the bond market. But otherwise, if you look back at some of the other periods of higher income growth, like the 70s, those were usually places where inflation took off and housing got pinched from the rate side of it.
Mhm.
Now, what you did end up having was coming out of that, you had from 1981 when rates peaked at 18%, which is just incredible that it got that high.
Yeah, it's wild.
Scary. And actually, the week that it got that high was that Halloween movie that came out in 1981. I went and looked to see that week when it occurred. It was October 1981. And so coming out of that, you had a long period where income slowly rose faster than like home prices, and rates started to roll off those highs and slowly come down, and affordability was slowly improved and restored somewhat to the housing market. And what you had is it took 13 years to go from the peak of existing home sales in like 1978 to get back to it. And I think it was like 91, 90, something like that.
So you've done some models on population growth and how that's kind of leveling off. Do you, and obviously, that has a factor with housing supply and affordability and some other things. Do you think that has any bearing to improving affordability in the future? Or, if you're going to, as these population models keep getting revised in the U.S.?
Yeah, so a few things with the population is that we have a long-standing secular shift in developed countries where people are having fewer kids and they're having them later, right?
Mm-hmm.
And what that's doing is it's pulling down birth rates, right? And so the population heading forward continues to get revised down in a lot of these developed countries, including the U.S. Okay, here we go. I was trying to slow down until I found it, but here's the census outlooks for U.S. population. And back in 2008, they expected, by 2050 to have 439 million people. Then in 2012, they pulled that down to 399 million. Then in 2017, they said, 388 million by 2050. And now, according to 2023 forecast, they say 360 million people. And if you zoom back to where we are now, 2023, they were saying it would be 351, and now they're saying it's 334. So right now in the US, we have around 18 million fewer people than the census expected back in 2008. And so already that has had some type of impact on housing. We would be in a different market that would have seen a lot more residential construction growth the past, 15 years had we been on the trajectory to actually having 18 million more people than we have today. Now, we might have had higher housing costs too.
I think so.
I think that's it's something to observe. We are definitely in a much better place than a lot of other developed countries. You look at places like Japan, some of these pockets of Europe. Those are the places to watch to see how the next several decades for us go, because they are really decades ahead of us on this, deceleration for birth rates and deceleration for population. I don't think it's that big of a story in the short term. I think this is more of a long term. We're talking 100+ year story for a lot of these developed countries around the world. And one other thing to keep in mind here is, while population estimates long term and far out have been coming down and declining, we actually, over the past, I would say 2 years, had higher and faster gains than were expected because we had a big burst in undocumented immigration the past 2.5, 3 years. That started to also roll over from the peak, but we did see greater levels of population growth driven by the undocumented population, which probably put more support into the multifamily side of the housing market over the past 2 years. And so I don't really think that drove up necessarily rents a lot, because the overheating for housing and for rents was a much bigger story, right? Of monetary policy, of how we address the pandemic, and also just the increased demand for space, work from home, all of that, and increased household formation that occurred during the pandemic. But what I do think is that burst of undocumented immigration probably gave more support to the multifamily rents, and probably buffered some of the declines that otherwise might have occurred had the burst not happened. Because we have seen multifamily rents roll over and fall some in some of these bigger boomtown markets like Austin, some of the Tampa area, like Phoenix, some of these parts where there was just a ton of this multifamily supply that that was financed during the period of ultra low rates, and so there was a big backlog of that multifamily supply. And then 2023, 24, a lot of that hit the market into 2025, and so last year was the biggest year for multifamily completion since 1974.
Yeah, with changes in immigration policy, which obviously would be a debate in DC, but we could change the course of our population count fairly easily if we wanted to recruit out of India and China and different places where, hey, we're still the reserve currency, the US dollar. We have a better business environment than, any other country. And so you could recruit like a college football team would, the best and brightest, and have an impact on that, population long term. I know that's a debate that's
that's correct. So that's the debate. And by 2038, right around here, you will no longer have births in the U.S. positively impacting population growth once accounting for deaths. So deaths in the U.S. will begin to outpace births in 2038. And then so all of the growth in population from 2038 all the way to 2080 will be driven on a net basis by immigration, according to the census. And then after 2080, at the current trajectory, they believe that U.S. population would begin to decline.
Yeah. And so my point there, you brought up like Japan. Japan doesn't have the advantage that we have. We're the reserve currency. People want to do business here. Our ability to recruit,
is
before
very
NIL, it's like Alabama, like we can be the Nick Saban of this deal. Agents, past clients don't exist. Unless, of course, you're retiring in 2025, then consider your clients in the past. But if you're building a business for the future, your clients are your clients. This is where Mosaic comes in, the client experience operating platform for you to manage the client experience. See, cupcakes are cute. It's a nice thing to do, but it won't keep a client tied to you for life. It's not going to bring the value to their home living, home ownership experience for years to come. CRMs work for lead generation, lead capture, and lead communication, while Mosaic helps you transform how you manage those relationships moving forward with the value that they actually need in their home ownership lifespan. So don't wait. Check out mosaic.io or find the link down below. We wanted to. I got one more thing, but I'd love for you to, Bobby, if you could bring up that Darth Powell tweet, Vlad the Inflator. So this is an X account that I follow, and Lance, you follow it. This account,
this guy's ridiculous, by the way.
Who is behind the account? Do you know who's behind the account?
I don't know. I don't know who runs Darth Powell.
Okay.
But, one thing I'll give him credit for is his engine is crazy because he's tweeting all day, nonstop.
This account tweets a lot, and so
he's very bearish on housing. Always has been. And one thing worth pointing out too is that he's had multiple of these years where he says housing's going to crash.
Yes.
And it hasn't, but
this is a historic doomer, and so it's the issue here, because there's a following on X with this account and other accounts like it, is some of this information gets passed on to everyday consumers as if it's the reality that we're living in. And this is a post about new single family homes, new construction hitting the highest level in 50 years, which if you just look at the chart, that's not even true. The highest level was pre-GFC, but then, I wrote back, this is super misleading when you're talking about inventory, because of existing single family homes for sale are still, really, at a low point. Inventory is still lagging what a normal market would be on overall inventory. I know new construction has, a buyer's market, but historically speaking, we're well below on the existing. When you add those two up, how do you think about current inventory levels?
So I think the thing that I would recommend to anybody is, if they have questions, they could, Google some of these data points, right? And so the one that he showed there, that includes some homes that haven't even been started, right? Homes that haven't even been started, haven't been completed. So if you want to see the better comparison of the buildup in unsold inventory from builders, you could Google, and I could show it here. You would Google unsold. Actually, let me just do it and make sure that I don't send people to the wrong place.
Yeah, and it's just, you get one X post in front of the wrong person. They tell their friends and relatives at a family gathering, and then it starts to spiral out of control. People think we're heading back to, some type of 2007 situation, which there's so many data points that prove we're so far away from any type of scenario like that. Yep.
Okay. So these are new homes for sale that are actually completed. The last chart showed it much higher because it was also like a backlog of homes that haven't even been started, right?
Okay.
And so we have seen this increase. And during the overheating of the pandemic housing boom, we saw it just plummet, right? Because there was just so much demand from buyers that everything in the market for sale was just getting absorbed at a record pace, right? Since rates went up, we saw that normalize. Now we have seen it push higher, and I've done some reporting here, and some of it is because builders, more of them have taken on spec homes, and so they think that they have, because there's a hole in the existing market, and they think they'll be able to, build these homes and sell it there because there's not enough existing inventory, and so they're preparing it for the spring. That's what MI Home CEO, and they're a Fortune 1000 company. He said on CNBC the other day to explain why this number has went up. But we have seen this go up, and I think a lot of it is probably, and well, we know this is concentrated in markets that have weakened, like Texas and Florida, right?
Yeah.
So some of the builders in these deep part of the exurbs, right, where they did a lot of building, and especially during the pandemic when people could work from home and there was just so much demand for those places, and they put up a lot of homes, and some of those homes have had a harder time selling, and so some of that has driven this up. And there are pockets of Florida and Texas passing through corrections, right? Punta Gorda, Austin, and so some of that has driven up the numbers. But some of it is like what the MI Home CEO said, that they're doing more spec homes because they just believe they can sell them. Now, the key there is to also look at active inventory for sale, and you can Google that. Realtor.com puts theirs on Fred's site, and you can see here for active inventory, yes, it has come up from the bottom of the pandemic, but it's still not even back to pre-pandemic levels. Yeah. And then pre-pandemic active inventory levels were actually, that was a 10-year slide down too, right? And so we don't have a ton of total inventory for sale in the U.S. housing market. We have seen some markets bounce back up, and I could show my data there.
Yeah, I mean, Southwest Florida, it's, certainly the case where it's above pre-pandemic. And then you got, places like Connecticut, which is still 60, 70% below pre-pandemic levels.
And so you do have 120,000 new homes completed for sale, but you only have 871,000 total homes for sale. And the Realtor.com data includes existing and then even some new construction as well. And before the pandemic, for a December, we were at 1 million consistently. So we're not back nationally to even pre-pandemic levels, let alone to a place that I would call like an inventory glut. Now, this is a map showing active inventory now versus pre-pandemic. And while the national level, we're still down 16% from pre-pandemic, there are many markets in the Mountain West, Sun Belt, especially Texas, Florida, that have bounced back. And those are a lot of the places that have driven the increase in the completed new homes for sale. And then, another factor is a lot of the country doesn't even build very much. Mm-hmm. Like, even if you had a situation where there was a huge, like, let's say that this chart for new homes for sale that are completed went all the way back to 2007 levels. Because there's so many parts of the Midwest and Northeast that just don't have much of a single family building presence relative to the 2000s, let alone to the early 90s, those places would never get that level of a glut for new homes. So I think with new homes, it's very much market by market right now, and there's a lot of regional bifurcation, and a couple of the weaker markets are what's driven up this bounce up here.
Yeah. I mean, going back to how we started the pod, for builders to kind of come in and want to compete with each other, they got to feel like the environment in the future is going to support that. Lance, this was great to have you back
very
on
insightful.
Here. Yeah, very insightful. Everybody should definitely connect with Lance on X. He's got a great account there to follow, @News Lambert. And then again, ResiClub is where you can connect with everything Lance is doing there. So Lance, really appreciate it. Anything here to wrap up that you think is important for knowledge brokers, real estate agents across the country to be thinking about?
I think just one final point, and I haven't published this yet, but I went back and I did a study of 50 years of the U.S. housing market, and I ran some statistical tests on it. Really wanted to test a theory that I had, and it proved to be true. But historically speaking and statistically speaking, the year that most years have most in common in the housing market is the year before. So, and it sounds like a boring concept, but it's important. And so, what that means is 2015 was most like 2014, 2016 was most like 2015, 2017 was most like 2016. And I think, 2024 was most like 2023. And I think 2025 will probably be most like 2024. Now, there could be some changes here and there in different areas, and maybe existing home sales finally starts to move up a little bit. But I think a truth of the housing market is it moves very slow. And so if you want a little bit of a guide for, where we could get what the next year might look like, it's always good to at least keep cognizant of the year that just occurred. Now, that doesn't mean that's always helpful because, you do have the years like '08, right? You do have the second half of 2022. You do have the second half of 2020, right? But the thing is, with the second half of 2020 and the second half of 2022, those huge swings, those are historical anomalies for housing, right? Usually you move much, much slower. So that was the last point. And if anybody wants to follow my work, just ResiClubAnalytics.com, or you could find me on X at News Lambert.
Yeah, those are both places everybody should get over to and sign up on each. We're going to link those down below. And we've been talking about that for a while. Without a crisis-like event or a historical event, as you put it, it's going to be hard to have a real impactful change in the market. So you got to work with what we've got here. And that's where knowledge brokers continue to separate themselves. Lance Lambert, thanks for coming back on. Really appreciate it.
Appreciate it, man.